Can you hear me? Yeah, okay, there we go. All right, so I'd like to call to order the Board of Trustees regular meeting for the City of Winter Springs, Thursday, May 8th, 2025 at 5:30 p.m. In the Commission Chambers, 1126 East State Road 434 in Winter Springs. Okay, and let's see, we are moving to roll call.
Chairperson Marco Santoro.
Here.
Vice Chair Ari Farid.
Here.
Board Member Michael Blake.
Here.
Board Member Brandon Fair.
Here.
Board Member David Withy.
Here.
Thanks.
Okay, please join me in the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, do we have any agenda changes prior to starting? Changes to the agenda? Okay, no changes?
No.
Okay, let's see. We're going to move to public input. Anyone that wishes to speak during public input, please limit your comments to 3 minutes, and representatives or groups of homeowners associations, please limit your comments to 5 minutes unless determined by the City Commission. Is there any public input before we start? Okay. Also want to welcome our police department tonight. Chief Tract and members of the police department, welcome tonight. Thank you. All righty. Let's see, we'll make a motion to approve the minutes.
So move. Don't. They're inaccurate.
Before we approve the minutes, just want to point out that there might be a couple of slight changes with the attendance. I know the clerk's aware of it, and it'll be updated. So the motion should include those changes.
Which were?
So we had a couple individuals that were marked absent that were there. I believe that's what Michael's referring to.
Yeah, it was a word processing error, I'm sure, that.
Yeah, typo.
That undeleted something that was changed from the previous meeting when others had a different attendance when they said aye.
So we did have Board Member Marco Santoro present, as well as David Withy. Was that correct?
Hey, were you here last meeting?
Would I miss it?
But were you here?
Yeah.
You know, I assume the clerk knows who was here and will make
Yeah.
the correct adjustments.
Yep.
Yeah.
All right, so,
I'll second the motion based on those amendments.
All right. Board Member Blake.
Aye.
Board Member Fair.
Aye.
Board Member Withy.
Aye.
Vice Chair Farid.
Aye.
Chairperson Santoro.
aye.
Thanks.
Okay, thank you, Christian, appreciate that. Okay, so we're going to move forward here with our regular agenda. And first up, we're going to have Shelley Jones, our actuarial from Gabriel, Roeder, and Smith. Thank you, Shelley.
Good evening, everyone. Should I pull this closer?
Yeah.
A little bit, yeah.
Oh, there we go. Is that better?
Yeah.
Okay. Good evening, everyone. My name is Shelley Jones. I'm an actuary with Gabriel, Roeder, Smith & Company, here today to present the actuarial valuation as of October 1, 2024. This really sets the contribution that needs to be made at a minimum by September 30th, 2026. The contribution is just one part of the calculations that are in here. We also provide participant information, accounting information that goes in the city's financials, state exhibits that need to be provided to the state. It's a very long report, but I encourage you to look through it all. But I'm going to try to hit the highlights for you today so that we can review it at a higher level. And that really starts on our executive summary, which is on page 4. So if you turn the blue book to page 4, on our executive summary, the first bolded number there really is the minimum contribution that needs to be made to continue to pre-fund benefits. It's $1,184,793. It's 28% of payroll. That $1.1 million is going to be partially met by member contributions and city contributions. We anticipate member contributions to be the second bolded number, which is $211,570. It's 5% of payroll. Remember, active members contribute to their pension by 5% of their payroll.
Shelley, I'm
Yes.
sorry, question, that payroll number, is that an actual payroll number projected for
It's a
that fiscal
projected,
year?
yeah, it's projected for the next fiscal
And
year.
do we have any assumptions in there for, like, some of the other rate increase assumptions that we use in the other parts of
So-
the actuarial study?
We have actuarial increases or salary increases that we assume.
So it's based on the assumption rates, not
Right.
on, do you know when, were those numbers the ones that were renewed back in 2022 for the assumptions review?
Yes,
Or
yes, yes. Yep, when we did the last assumption review.
Okay, thanks.
No problem. The remaining minimum payment is the last bolded number there, $973,223. It's 23% of payroll. That's the city's minimum contribution. That is lower. The city's contribution is lower this particular year because we had gains, particularly on our assets. On a market value basis, we just did phenomenal in terms of the market value. Return was 23.74% for fiscal year ending 2024. But remember, when we do our calculations, we don't necessarily use the market value of assets. We smooth it over 5 years. So the smooth value of assets was better than our assumption. 9.38% was the smooth value of asset return. Our assumed rate of return is 6.75, if you recall. So really good, really strong, smooth return, really great market value return. On the liability side, we did have some losses, but overall there was a gain on the plan, but we did have some offsetting losses to that gain. On the liability side, that was mainly due to salaries. Salaries were higher than we had anticipated. And so on the liability side, there was an offsetting gain or loss. But overall, there was a gain on the plan. The funded ratio, in turn, increased on a smooth basis from 88.3 to 90.8%, or 90.8%. Any questions on that so far? We didn't change any of the assumptions. We didn't change the plan itself did not change. So everything that happened this particular year was experience. The main figures of the report are on page 13. And so I want to take you there. On page 13, you can see we have last year's valuations figures. On the left-hand side, that's October 1, 2023, and on the right side is the October 1, 2024 figures. And you can see active employees decreased about 7%. Overall, the planned population, if you were to add items A1, A2, and A3, you'd get a decrease of about 1%. So the plan itself shrank slightly. The active payroll, item A4, increased 3%. Despite the active population decreasing 7%. The total normal cost, which is item B, is the cost of a year of benefits for all the active employees. And that increased as a dollar amount, increased as a percentage of pay. Again, really driven by that payroll increase. The unfunded accrued liability, which is item G, is the difference between your accrued liability and your smooth value of assets. And that decreased as a dollar amount, decreased as a percentage of payroll. That's what you want to see there. You want to see the funded ratio improve, the unfunded liability decline. And that is what happened from 23 to 24, again, mainly driven by that asset return on a smooth basis. That really led to the city's minimum payment dropping as a dollar amount and as a percentage of payroll. That's item H. The funded ratios all increased. The bigger increases are the ones that are due to,
Excuse me, I'm sorry, Shelley.
yeah. Yep. The market value basis, which is the first two ratios in item I, increased pretty dramatically. And again, that's because we're using that market value of assets, which had the 23.7% return. When you utilize the smooth assets, which is the last ratio, you see a smaller increase, but still an increase in the funded ratio. Any questions on those ratios or anything here? Page 15 is the assets. And it really, on a market value basis, you guys look at your assets, I assume, quarterly at the very least. So this should be kind of, this should be old news for you. But as of the valuation date, this is where you were invested in terms of allocation. You can see the majority of the assets are in item B1, which is common stock. The plan assets in total at a market value basis as of the valuation date was about $78.9 million. That's item E. On the next page, if there's no questions on that, on the next page we give a reconciliation of the assets from last year to this year. So on page 16, you can see the market value of assets last year was $66.3 million. We had receipts into the plan of contributions. Remember, members in the city contribute. That totaled $2.3 million. And then we had the big investment gain, and that was $15.4 million. So total funds kind of coming into the plan, if you will, on a market value basis was $17.7 million total. And then we have to pay the pension benefits, and that's the main disbursement. Item C is the pension payments of about almost $5 million, administrative expenses of $67,000 for a total of $5 million in disbursements to get you that ending value of $78.9 million. Any questions on that? Really good market, 15.4s. Actually, I wanted you to remember that number, 15.4, on page 17, the next page. You can see item E1 is in the 2024 column, is $15.4 million. That's how much the market returned this particular year in dollars. We had anticipated in dollars the investment return to be item E2, which is $4.4 million approximately. So you could see there was a big difference of $11 million of extra additional market value return that we received. But we're not going to say, in our calculations, we're not going to say, let's utilize all that $11 million. Well, let's space it out over the next 5 years. And so that's what we're doing in this calculation in item F. And you can see we're adjusting the market value to be a smooth value, which is what we utilize in our calculations, to get a smooth value of assets of $72.4 million approximately. I wanted to also mention item H, which is last year. When I was here, I told you that there were unrecognized losses because of fiscal year 22. We knew we had to smooth in losses, and so that was going to be kind of a headwind on the contribution. The contribution at a minimum was going to go up. With this year's market return, we flipped that script, and now you can see item H went from negative 2.4 million to a positive $6.6 million. So essentially, there's $6.6 million of unrecognized gains that we know we're going to be recognizing. You can see where those are going in item F6. And essentially, that will lower the minimum contribution to the city, given that we haven't recognized these gains yet.
I have a question. So
Yes.
when you smooth it 5 year, do you reset it every year?
No, we've smoothed it. We smooth it by the dollar. So every 5 years,
It rolls off, right?
it rolls off, but the beginning is the prior year's smoothed, if that makes sense.
Priors. So we have, we had losses in '22 that kind of smoothed out in '23. We have gains in '24 that we're going to smooth out in '25. So it's a running number for the 5 years.
Yes,
So pretty much resets every year based on the last couple of years.
yes,
Fair. Okay. Good.
yes. So there's a little bit of volatility there because once that last year rolls off, we're going to put in a new one. That makes sense. Any other questions on this page? If not, page 45, kind of towards the back of the report, is the experience to give you a sense of what's happened over the longer term, over the last 10 years. On page 45, you can see this particular year, again, the salaries were higher than we had anticipated. For general and forensic employees, actual compensation was 22.5% of an increase. We had assumed 5.1% of an increase. The police and fire had a 14.5% increase. The assumed was 4.9%. The termination was generally, for general employees, it was a gain. There were, for general employees, it was a loss. There were fewer people that left than we had anticipated, but it's a smaller group. So on the police and fire side, there were more terminations than we had anticipated, and that was a gain on the liability. But again, overall, we had a small loss on the liability because of the salaries. Any questions on that? The investment return, again, on a market value basis, 23.74%, really, really strong return. On a smooth value, 9.38%. The assumed rate of return was 6.75 last year. Over the long term, if you look all the way at the bottom, the last 10 years on a smooth basis, we've got 8.8% return versus our assumed rate of return of 7.6%. So just over the long term, on a smooth basis, we're doing better than our assumption, and that's a really good thing to have. Really good.
Shelley, I do have a question. Going back to the upper left there for October 1st, 2024, the actual being up 22.5% versus the assumed rate.
Yeah.
That is obviously a pretty meaningful difference. And did I hear you say also the head count went down?
Yes. Overall, on the active side, yes.
Okay, so the number of people we're paying went down, but our
No, well, this is just looking at last year's salary versus this year's salary for those who had 2 full years of salary. We're taking out that noise. Yeah,
Okay.
we're taking out the noise of kind of the change in the population. We're sort of just looking, hey, what were salaries last year? What were we expecting them? Where were they actually coming in?
Thank you.
No problem. Any other questions on this? I wanted to go on the next page really quickly just to show you the funded ratio, the history of the funded ratio. If you like numbers, stay on 46. If you like a graph, go to 47. I prefer 47 myself, just because I think visually it helps you see over the last 14 years, the funded ratio of the plan has done really well. Even when you can see the general trend is upward. Obviously, we're landed on 90.8 on a smooth basis. This is a smooth basis. This chart is the smooth asset value. You can see there have been points where we've sort of put downward pressure on the funded ratio because we've changed the assumptions, particularly the investment return assumption, but also mortality has changed some of the, has sort of put pressure on the funded ratio to kind of move it downward, but we've sort of just even though we've strengthened our assumptions, we've gotten still an increase in funded ratio over the last 14 years. So really good job. That's what we as actuaries want to see. We want to be 100% funded. That is the goal of the funding. But it is, we want to see progress towards 100%. Any questions on this? On the next 2 pages give you the market value, which is obviously,
I have a question.
Sure.
Go back to you.
Sure.
Going back to that.
Yeah,
chart. So, history of funded ratio, everything was very good. But as you're well aware, the assumptions behind that can make it look better than it should, or it could look stronger. Would you say, in your opinion, the assumptions that are being used here, in my non-actuarial opinion, they appear to be pretty conservative? So that would suggest that a 90% funded ratio might compare much more favorably
right.
to other systems that are using more aggressive
Right.
funding.
Certainly. I think the average, particularly, so the main kind of assumption that is utilized in the calculation is the investment return assumption. Generally, for our plans, the average is probably around 7.1%. We're at 6.75. Obviously, we haven't changed that at one time. We've changed it over time, and that's generally how most people do. But we've strengthened those assumptions.
You're talking about governmental plans, right?
Yes, governmental, Florida, yeah, comparable to this plan essentially.
And then the AM schedule that's being used to discount the unfunded or pay off the unfunded, 25 years,
Yes.
right? So
Yep.
That's pretty standard.
That is pretty good. Yeah, the most you can do is 30 years, but 25 years is
So it's a
is
step
good.
again towards
Yes.
more conservative funding.
yeah. I also wanted to mention too that the city has contributed more than the minimum, and that has helped the funded ratio as well. So that immediately increases the funded ratio as well. So there's good experience over the last 10 years on a smooth basis, as you can see from the investment return, from an investment return standpoint, and then contributing above the minimum. Kind of both of those things have sort of propelled and paying the minimum at least basically gets you to an upward sloping graph that this that this is showing. Basically, what I'm saying is it's working as planned, because we want to be 100% funded, and that's where we're going essentially.
Shelley, you may not know the answer to this, but since we are halfway through this current fiscal year, this year's obligation of at least $1.18 million, do we know where we are with that year to date?
Good evening. For the record, Holly Queen, Finance Director. We are at about 822,000 year to date.
Thank you.
Nice. So the graph on page 48 and 49 or the chart and the graph is the market value. So you can see the funded ratio is much more volatile, particularly in the last couple years, right? Fiscal year 21, 22, up and down the roller coaster, and now back up again in 24 and 99.1% as of on a market value basis. On page, any questions on that? Page 53, sort of where I'm going to wrap up the discussion. So currently on a smooth basis, we're about 90% funded. So there's a difference between our smooth value of assets and the liabilities of about $7.3 million. That's the current unfunded liability all the way at the bottom there, the total. And you can see we're paying that off on various bases, the longest being 25 years, the shortest being 6. And essentially all those amortization payments, you can think of them as a mortgage, are total $602 million, or sorry, $1,000. So essentially your contribution is this amortization payment, the $602,000 and the normal cost. And those two together, essentially is the contribution, with interest, essentially.
So once that is gone, then the city's costs are 100%.
On a-
12% of pay, right, for the normal cost?
I think it's a little higher than that, yeah. I think it's a little higher than that. I
Dave,
wanna
would
say
you mind
12.
clarifying the question?
Ask the question
Would you mind
again.
clarifying that question you were asking?
Oh, you're right. it is
I was asking, once the unfunded $7.3 million
Yeah.
Goes-
goes away, then the obligation will be reduced to the normal cost or
Which
the
is-
regular operating cost of the plan. And I think I saw on there.
It was 12.4.
Okay, which,
That's
again,
really low.
Yeah,
Yeah.
that's pretty,
510,000 a year is
Yeah,
what is current year, right?
yes, the current years, yeah. Yeah. The, if there are no questions or any other questions or comments?
I have a question.
Sure.
You work with other places like Winter Springs.
Yes.
Are you seeing any activity in the marketplace with the folks that you're working with respect to de-risking, partially de-risking?
Not
Yeah.
too much.
None at all? No interest,
No-
really? or-
Some interest, but
Anybody-
not a ton.
Anybody doing it?
More termination
Right.
based than de-risking per se, partial
Mhm.
de-risking.
if I may, would you be asking about de-risking as in annuitizing? Or
Perhaps some portion of the
Within
plan.
the portfolio, moving to slowly de-risk a portion of.
Yeah, I'm talking about it either annuitizing or selling off some of the risk. Right.
Yeah,
Primarily the term vested people in pay status.
yeah, it's been generally a couple of plans, and it's been with termination. I think they were on the sidelines because rates were so low. And
Rates
then once,
right now are sort of in that spot where it can make sense, not for
Right.
everybody,
right,
right? But we're closer today than we've been in the last 20 years,
right,
well, 18 years.
you're right. So I think those that were kind of waiting have in the last couple, 1 or 2 years, but not huge numbers,
Okay.
not huge numbers.
Does your firm have any experience in going through that process, either with a
We do.
governmental
I
or
would,
commercial plan?
I would probably set you up with one of the other consultants that has gone through it completely, so that it's a full service type of thing.
Just a question to the city staff members here. Has there been any discussion of looking at possible de-risking of part of the plan? I know we have a new city manager and, perhaps new folks sitting up here. So I don't know if that's come up yet or not. See how they're looking at each other?
I do.
Because they know this is on TV.
We haven't gotten into any real deep discussions with the city manager about it at this point. But we did have one individual, when he came on board, very beginning, asking about that and had asked if anyone had ever talked about that. But only one.
I mean, it's a big decision, a big project, and I know the city has a lot on this plate right now, but if there's a way, when we look at I always forget, is that a graph or a chart? That's a graph, right? We look at a graph, actually, let's look at the other graph. If we look at a graph, right, and we can find ways to maybe remove some of the roller coaster and better define with some certainty what numbers there are, and then just have a smaller portion where we're at risk. That's the reason, right? That's the idea
Yep,
behind doing it.
yep.
And there's a way to do that from the investment standpoint as well. I understand that, and we could maybe even consider bifurcating a part of the assets and doing that. For or members on the plan, that these types of strategies don't do anything to change your benefits. They really just act to change the predictability of the funding for the plan, which helps to make certain that the funds will be there in order to pay the benefits. So we're not talking about a change in benefit of any level.
Yeah, if I may, I think from an actuarial viewpoint, again, speaking as the non-actuary here totally, we have worked on some other projects, or have, I guess, have some projects in the works right now. There is interest developing as plans get more developed. And we would be working, and you have provided a schedule of cash flow in the future in conjunction with evaluation. So, I mean, that could be something we could look at. We could, I don't want to use too strong a term here. I don't want to say we would be immunizing, but we could take a look at the present value of the net liability, and we could construct a bond portfolio that would basically, be dedicated and retire that liability, and then leave, I think they're suggesting, the other portion of the portfolio. We can afford more volatility, or we can afford to accept the volatility, because we would have this portfolio dedicated. If that's something there's an interest in doing, it is a big project, but, we can.
It
we can
definitely,
work together on that, and
it definitely
know,
will
come
lower
up
the
with,
funded ratio risk, the risk
Exactly.
of, the risk to the
draft of what it
funded
might
ratio.
look like.
So we up here aren't in a position with any authority to initiate something like that, but maybe to staff, if there are some internal conversations that could look into the viability of doing something. One thing that strikes me on page 43, the projected benefit payment stream, I'm surprised how level that looks. Has that, if we look back 3 or 4 years, would it, the other 7 years that are here, would it be pretty much in line?
It should be,
Yeah.
yeah.
I know it
because
should
our-
be, but it's changing something,
Well,
something else.
yeah, and but if we were way off on the liability, our gain loss would be a lot bigger every year.
Right.
And we'd be like, oh, the liability is way different than what we had anticipated. What's going on? And it could be the expected payments were different than what we had,
Right,
what
right.
the actual was. But in general, we haven't seen that. We're generally pretty close.
Do you know what year they start going down?
I don't on me.
Okay.
Because
I know.
we send them the
I know
benefit
you do.
stream and I
I'm
haven't
not
looked
trying
at
to put you on the
it.
spot, because I get it, this report is what this is, but I didn't know if you happened to know,
but yeah.
because that's, that
I
inflection
imagine-
point is kind of interesting also,
Yeah.
if we had it.
Right.
Okay. I'm done, sorry.
Oh, good. So any other questions for Shelley? Okay, thank you, Shelley.
problem.
Appreciate it.
After,
How long have you been doing our valuation?
I've, like 8 years. I worked
That
with
was
Larry.
long.
Larry was
Right.
Larry was
We
the
already
main
have.
consultant. I was, doing the calculations
Yeah.
behind the scenes.
You're doing the work, you got the glory. You said,
And now.
okay. Thanks.
But after you, if you do vote, I would like to mention something about next year's valuation. That's coming down the pike, but
Okay.
unless you want me to talk about it now, I can.
All right, any other last questions? Okay, thank you, Shelley, so much for your report. Yep, motion to accept the valuation.
Yeah, I'll make a motion that we accept the valuation as presented with thanks to GRS.
I'll second the motion.
Board Member Blake.
Aye, and I guess I should have said and forward it to the city commission, with our approval, but aye.
Board Member Fair.
Aye.
Board Member Withy.
Aye.
Vice Chair Fareed.
Aye.
Chair Santoro.
Aye.
Thank you.
And then one additional item, the Florida retirement system has updated the mortality assumptions, and we have to utilize their assumptions for mortality. they're the only ones who have kind of credible data to do mortality assumptions. And so they have kudos to general employees and safety employees, police officers and fire that are in the plan. Life expectancy is increasing. That does mean that the liabilities are also increasing.
Yeah, that doesn't help us.
Well, yeah, good news, bad news, I guess. Good news that people are living longer. But that will increase the liabilities overall. On the police side, it'll probably be about a 3% increase in the liabilities. On the general side, it'll be about a 1% increase in the liabilities. So more life expectancy on the police group overall. But I wanted to let you know that we have to do that next year. So when we do our evaluation next year, we will be changing those assumptions because we have to. Okay,
Thank you.
no problem. That is all.
Okay, thank you, Shelley, again. We're going to move forward in the agenda to David West with Mariner with regards to the quarterly investment return report from Mariner. Thank you, David.
All right, good evening, everyone. It's very nice to follow a actuarial report that shows solidarity and solidity as we embark through the unknown here. I know everyone on this board is fully apprised and aware of what's going on. Obviously, it's a tariff tantrum, and we are, I guess all I can add to the table maybe is that you are starting to see the initial effects of the tariffs. There was a lot of front running of inventory in December. My son happens to be in the merchant marine industry, and I've always followed that as a great economic indicator anyway. If you follow Long Beach and LA, forward orders for ships anyway from the Pacific are down 40%. And there's a lot of ghost ships going back, a lot of empty containers going back across the Pacific there. So needless to say, this is going to have an impact on the longshoremen, the truckers, everybody that fingers out, spider webs out from this whole thing. I will unofficially just share a more localized, down-to-earth story. I have a friend who has a very successful, globally distributed sports equipment manufacturing company. He specializes in windsurfing sales, kiteboarding, and water recreation like that. And he has always had his sales built in China, which is where, by no coincidence, all the other competing manufacturers have their equipment put together. I guess 2 points here. Number one, he does all of the high dollar, high education required R&D and development, and then he sends his plans from his group over to be manufactured in the most cost-effective manner possible. So with conversations with him, he has completely stopped. He's had a run on his existing inventory, worldwide, and he stopped all production on any future manufacturing from China, and it appears his colleagues are doing the same. So now let's get back up into the stratosphere, and recent comments from Ford's chairman are a little bitter, and he's indicating that possibility. We have to watch out for fake news. I try to watch it, from the horse's mouth when he's being interviewed. But there's some question of whether or not they're going to close down some of the U.S. manufacturing as a result of all this, which could be a function of slowdown. But nevertheless, we're starting to see the impacts hit us. I don't know any daughter who wants to choose choice of $2 instead of $30. But needless to say, that's where we are. We don't know if we're zigging or zagging in here, but we're glad we're in sound actuarial position. And I think the portfolio is pretty well diversified. And believe it or not, we've actually been weathering this whole thing reasonably well. So I know you have had the opportunity to go through the report, so I won't belabor things here, but if you go to page 12, our asset allocation as of March 31st, everything's in line. Again, we continue to hold a little bit higher cash than we might otherwise. And we did effectuate a rebalancing that was directed by the board during the quarter. Remember, we took off some of that, a little bit of the international equity allocation there and moved that aside. And the net effect of that was to move $1.7 million out of the RBC International Equity Fund. And we actually did put a little cash to work also in conjunction with the sale into the Vanguard Short-Term Bond Fund. So while equities, international equities were the best positive performer during the quarter, I still think that was a judicious move, to get things closer to center to the longer-term targets. And the short-term bond fund certainly produced the coupon it was expected to deliver. So so I have no action recommendations from an allocation standpoint right now. We have a sell order, just reminding everyone, we've got a complete liquidation order for the real estate fund. We'll continue to get dribs and drabs from that, although the last 2 quarters have seen positive returns. And then, the other item on the table we'll be talking about today is how we're going to drive the international equity allocation itself with the manager. So from an asset allocation standpoint, unless anybody has any comments or anything to add, I have no action recommendations here. I think we keep our heads down, stay to the middle, and we'll ride this out.
Mr. Chairman.
Go ahead.
On the real estate, have we received any updates in terms of how the door is doing? Are they, sending any money out, or do we have any indication as to when they're going to unlock it?
Yes, we have, and we track that on a quarterly basis with all our real estate managers, and I have it, I can't pull it up fast enough.
Right.
But yes, for Intercontinental Real Estate, they've been one of the few managers that was actually continuing to try and address redemption queues, although it was modest amounts. And they've recently picked up the pace. But the queues, there's no change in the exit queues right now. So that's, if you want some exact numbers, I'd be happy to pull them.
Just an indication of whether things are loosening up at all.
Yeah,
As
I
of
think
yet,
it is.
still
I think
holding
bottom line, it is starting to loosen up a little bit.
Did they halt redemptions, or was that just normal course?
I'm sorry?
Did they halt redemptions, or was that normal course?
It's an open-ended fund structure, which means with 45 days to 90 days, depending upon the manager, we give them notice, and we should be able to receive part or all of our redemption requests. However, during times of duress, the manager reserves the right, in the interest of the long-term investors, to close the door and to piecemeal it out in a fair manner. Again, protecting the long-term investors that expect to stay in the fund. So it's normal, but the lockup is abnormal because we're in an abnormal period of time, if I'm answering the question.
Yeah, I mean, there was not an abrupt, a halting of the fund redemptions, is what I'm getting.
Right.
Yeah.
And they have that, so. So any other comments or discussion on the asset allocation? I guess we might need an action to take no action.
Okay.
Move to accept the investment report.
I'll second the motion.
So for the investment returns,
Let me take the roll real quick. Sorry. Sorry. Board Member Blake.
Aye.
Board Member Fair.
Aye.
Board Member Withy.
Aye.
Vice Chair Fareed.
Aye.
and Chair Santoro.
Aye.
Thank you.
So bottom line, it looks like fiscal year to date, the fund is down probably 1.5% or so. We did have a recovery in April, and so we should be seeing modestly positive returns in April. So that's a little bit of a retracement of the loss there. So given the volatility and the hype, I was happy to see the damage has been pretty minimus. Yeah. All right, so that takes us to the next agenda item we had scheduled, which was to consider potential replacements for the RBC International Fund, and just referencing, so you don't have to open the page, RBC for the quarter was up around 6% versus the EFA benchmark, which was 6.8, so modest underperformance. If we compare them to the value index was up 11.56%. So, we didn't get to see the turn in performance for this quarter. The previous quarter underperformance was a function of exposure to South Korea and the geopolitical events going on there. This quarter, the net negative or net underperformance was largely a function of materials exposure, primarily in Canada and Ireland, but mostly the Canadian exposure that they had there. And obviously that was a function of the tariff conversations going on there. So that's where the lag came from. So we put together a manager analysis, and I think we agreed that we would continue or maybe move to more of a core-oriented manager, right, with flexibility for a value bias or a growth bias as the manager see fits, but they would mostly be running center court. If you go to page 2 of the report, here's a listing of the managers. We have Dimensional Fund Advisors, which is strictly a quantitative strategy. The management fee for that one is 30 basis points. T. Rowe Price is at 67 basis points. That's definitely a bottom-up, larger cap orientation manager. The TA or Transamerica International Equity at 0.75% or 76 basis points. Again, bottom-up fundamental manager. And of course, we're running everything against RBC, which has a significant value orientation with their huge focus on sustainable cash flow being purchased at a reasonable price. So I won't take you through everything. I'm sure you've looked at it. You all know how to read this stuff. I'm just going to point out a couple of differentiating highlights as we go through here. If you go to page 11, if our bias is towards a larger capitalization manager rather than, fully up and down, then the T. Rowe Price or Transamerica would fall into that. You can see there's the long-term factor analytics on them as far as capitalization goes and relative to the index. The T. Rowe Price fund is the only one that actually closely tracks the index there. The growth value score on the right-hand chart there, everybody's, pretty much shooting down the middle there most of the time. And graphically speaking, to borrow from your actuarial term, picture is much better. If you go to page 12, you're all familiar with the style charts there. So currently in blue, currently in the silver most, that's RBC, definitely a left court value bias to that manager, and everybody else is much more center court. Pictorially, the right-hand chart there, that's the historic with the most recent going back all the way to, in time, to the smallest dot representation there. That's where those managers fall. So most of the managers have a value bias of some kind on it, which is shifting it, the characteristics that are being captured a little bit left. And I think this goes back to a little piece of screening that we did per our previous conversations. Our interest in international is not, growth, gangbusters growth, and being, trying to be maximize upside market. It is to participate and hopefully get some downside market risk, which then puts us into the camp of the more value conscious modeling and also a bias to capitalization. So I won't go through the returns. All these managers were screened by our research team, but I will look again pictorially at page 16. Here's the return rankings, and then again, I'll just remind everybody, these are mutual funds, so everything we're looking at here is net of fees. And, the return differential, it is a little skinny once you net out the fees, but that's how everybody plots. If you look at the bottom chart, I think that's the best one. That includes the peer group rankings in shades and the actual manager returns on a rolling 3-year basis, adjusted quarterly. I think that's much more meaningful to follow a rolling period return. Question?
Yeah, well, the only one that's available as a CIT is the RBC. The other three don't, like the DFA or I'm not sure about the Transamerica, but the DFA or the T-Road, they don't have a CIT available?
I believe they do have a CIT, but the share class, the mutual funds, the share classes were the most expensive option, according to my research.
Wait a minute, were the most expensive option?
Inexpensive,
Inexpensive.
least expensive, yeah.
Less expensive than the CIT? I mean, I don't know, I didn't look it up, but
Yeah, because we did discuss product delivery, and, mutual fund was preferred as long as the expense ratio is at least equal to any CIT product.
maybe. Yeah,
Now, I can absolutely
if
go
we're
back
looking
and
at one of the other.
confirm that,
Yeah,
yeah.
if we're looking at one of the other three, before we make a final decision
Yeah,
on the fund, I'd like to know whether or not there's
yeah, absolutely.
something else out there, a CIT that would be available.
Okay.
Lower expenses typically is the primary reason.
So continuing on through here, just cutting to the chase a little bit. If you go to page 20, I'm going to skip right up to the longer time periods. The risk-reward ratios there, up capture, down capture. Most of the managers are providing more marginal up capture than down capture. You have to go to page 21 and get a more meaningful period of time, especially for a strategy like DFA that's quant-driven. It takes a little more time for those, singles to add up meaningfully statistically here. So DFA happens to show up with the best down market capture. And on that, let me skip you up to page 27 and 28. So on the down capture, if you're just bring your eyes down to the bottom line item there in each of the tables. So the first one is, I'm sorry, page 27. So if we look at the down capture, which we think is significant, obviously, DFA is at 90%. The other managers are close to 100%. RBC at 91%. Extending out the time periods more meaningfully. Again, DFA at 96 for a 5-year, 7-year. DFA is at 100%, and you extend it out to a full 10-year period, DFA is at 96%. So that manager would show up with the best down market capture. It also has the highest number of stocks in the portfolio.
Is that a real number? Go ahead. Is that a real number is my question. How many holdings do they have?
They're supposed to have 8,000 holdings.
I thought it was 10,000.
I mean, no, I am aware that the strategy has
10,739 is what
a
I said.
huge number of holdings, yeah.
What don't they own?
Yeah, right.
I mean, I saw it, I've circled it, I'm thinking, is that a real number?
Yeah, I think we'll fact check that one, but I do know, my familiarity with the manager. I
The
do
index
know
is only
they have a lot of
722.
holdings. They're like 1%, 2% positions, no more. But I'll fact check that one.
It says, top 10 holdings is, I drew through it, is it 8 or 6.25%? It's just, there's only 722 holdings in the index, right? So I question that number, I think it's wrong,
Yeah,
but it might not be.
yeah, we'll fact check that one. So those were really I think the distinguishing factors. DFA is down more in capitalization. And they regardless of what the number is, they have a much higher stock exposure, stock population in the portfolio, and they have a much higher exposure if we want to look for more emerging market exposure. And again, not included in here, but always an option, of course, is indexing the allocation here with something like the Vanguard FTSE, all world ex-US. Never want to, we don't show it because obviously you know what the returns are going to be, but that's always an option for consideration. So I guess just an interesting side note, which may be a good thing or a bad thing, but DFA is populated with some Nobel laureates that we all know, Eugene Fama, Robert Burton, they all sit on the board, and there are a number of other, high caliber individuals behind the quant modeling for this firm. So interesting strategy, and they ferret out small differentials, and it really takes a longer term period of time to accumulate the down capture advantage and the net outperformance over time. But those were our recommended options, again, with a bias towards looking for managers that, hopefully might be able to give us a little down market correction rather than shooting for the moon. So those would be the picks. Let me just stop there for any discussions. And
So David, it sounds like that some of the metrics, the down capture ratio is important to you. Can you elaborate on that again?
yeah, I think so. And if I could use the actuarial situation as an example, I mean, we all know the concept. You need money to make money, and I'll just use the example. I mean, if a plan is if plan loses 50%, they have 50 cents to work with, right? So you need to be up more than 50%, obviously. So the preservation of capital, as the math works, is pretty important. So for situations like this where, we're not really trying to shoot for the moon for returns, I think preservation is better if we can get it to have there to, to preserve asset valuations.
So like a score of 96.53 compared to, 100 or 100 plus, what does that mean exactly?
Yeah, so the other managers are basically not giving us any down market preservation, yeah.
Okay, so the
But they
lower,
are giving us more upside
yeah,
than DFA is.
Okay.
And part of the modeling behind the DFA academics is to try and address that down capture. So that's why it does have that bias.
So
Okay.
the way that works is if the market goes down 10% and you're capturing 100% of the downside, then your portfolio went down 10%. If you're capturing only 50% of the downside, which would be amazing, then your market didn't go down 10%, it only went down 5%, 50% of the 10% decline.
yeah, okay.
And so at 96%, it's all tight numbers, right?
Yeah.
Because these are big portfolios and
Yeah.
everything. But what it means is, basically, as the market goes down, history, your fund has not gone down as much. Same time, though, if you're capturing 110% of upside, that means if the market goes up 10%, you're going up 11%, right? 110% of that.
It's a more nuanced version of beta, basically.
But in terms of weighing what's important, again, if the market goes down 50%, it has to go up 100% to get even. Right? It's twice as hard to make money. And so from the long-term nature of what we have here, we want to protect more on the downside with good returns. So, because the market goes up and down.
That's correct. And that was the original intent behind hiring RBC, actually, who,
Sure.
during previous decades, had a remarkable down market, especially during the financial crisis. But they have not been able to achieve that same level of protection in the more recent decade.
Thank you. Okay, so David, it seems like that you're leaning towards DFA? Is that like your top recommendation?
I think yes. Again, like I said, I'm also completely open if we want to index, the entire equity portfolio, domestic and international. I'm not going to get in the way of that. I think the index fund is institutional share class is at I think it's 5 basis points for that particular fund.
But, international portfolios, I'm an index kind of guy frequently, not always. I do stupid stuff too. Rarely, I think, do you attain the additional value of the additional cost. But when you're talking about junk bonds specifically, or like international funds, gray matter really does matter and can help, and especially on the downside provision, right? And I think that's kind of the key here. So I would move more towards active for this segment. is
I
what I'm
wouldn't
saying.
disagree with that, yeah.
The
And
only,
we could argue about it all day, and we could all change our mind too, but it's an art, not a science.
Yeah, and just to throw out one other, I don't want to call it a disqualifier, but, the T-Row price strategy, Ray Mills, who was the PM for that strategy, retired, and his co-PM took over in April. So we're really looking at, it begs the question, whose track record are we really looking at here? Although, again, my research team has suggested that, the transition has been in place for a while, and they're transitioning completely. But, in my mind, that's a replacement of the, key driver of what we were looking at anyway. So
That's probably what they got.
That breaks
That's
it
probably wrong,
down.
too, 'cause that number's exactly the same.
the only other question I'd have around, if I may,
Yep.
potential for indexing there, because I don't disagree with Councilman Blake, but standard deviation on the index, 15.23 versus 16.01 on the DFA fund, wouldn't that also hypothetically, in a much more cost-efficient way, give us a smaller variance of possible outcome there as well?
at that fee, absolutely, yeah. Yeah, that's very low active management fee.
Yeah, no, it is, yeah.
Now, I'd be happy to check, was it the Transamerica fund you were referencing with the CIT?
No, the DFA, I don't know if I thought DFA and, I don't know of one for Transamerica, but I thought T-Row and DFA had one in this segment, but it's probably not the exact fund. I just looked real quick and couldn't find it, but
Okay.
I didn't, that doesn't mean it's not there.
I don't want to leave anything on.
No,
unlooked
what
at.
I would want to do, what I would recommend is if we're going in that direction, would be to first ask you to go and research to make certain that there isn't a more favorable cost level available for us, which would likely be only in a CIT. Or if you, I don't know if you have any special revenue deals available with them where we can get an additional discount. How many dollars?
9,
0.95.
9.5, I think.
9.5?
9.5, yeah, just under
Yeah.
10.
Sometimes you can make a deal with that. But ask the question, right? Call the guy,
Yeah,
ask the question,
absolutely.
and see what they might have available for us to make the move.
Yes,
And if we can get some enticement there, then that would only help us.
I'd be happy to do that.
Hypothetically, just ask the question, if a CIT is not available and the option only is the institutional share class, are we able to approve that ahead of time on that condition, or would he need to come back next quarter to present that, no, that was indeed the lowest share class option, or the cheapest option?
No, I think we can give the full direction and know, if they know the path to go, then they can handle the full transaction, because they'll know the answers.
Okay.
I think.
Appreciate it.
Okay, so, sounds like we're at a motion here.
I think
Yeah, I'll
Brandon
make a-
was gonna make one, yeah.
Yeah, I'll make a motion to replace with the DFA fund,
With caveat that he's.
with the
go back
caveat that,
and
yes,
Do all
thank you,
those
yeah.
fun fee things that.
Right,
we
and
do,
that
see
would,
if we can get a-
and you're looking for all of the funds, or if there's an alternative for the
specifically for the
DFA?
DFA fund is the
Just the
motion.
DFA?
Yes.
Yeah. Okay.
I'll second that.
Okay. Board Member Blake.
Aye.
Board Member Fair.
Aye.
Board Member Withy.
Aye.
Vice Chair Fareed.
Aye.
And Chair Santora.
Aye.
Okay, and then if I may, administratively, I don't know if it's necessary, but we'd be authorizing the city to take direction to complete the transaction, to either A, go into the mutual fund, or B, or A, go into the CIT at lower cost, or B, go into the mutual fund. And we'll also need to give direction, because we have no authorization, so you'll be authorizing them to liquidate, direct liquidation of the RBC fund.
So I'm always confused by that, because we're an advisory board of trustees, and it's actually only the city commission can actually transact business. But I'm hoping, but all the other things that we've done, whenever we've made a transaction, I think this board's been empowered to give that direction, and it's occurred.
Yeah.
The thing is, if it's a CIT, then it's gonna require signing on a trust document, which means somebody of authority in the city is going to have to execute it, probably the city manager or his designee.
Yeah, they would be
Which-
subject to legal review,
Yeah.
right?
So. Right?
And you are
Hey.
you are the authorized signers on everything already, so to your point, it may not be necessary.
I mean, I'm just trying to be careful with respect to the governance of the city and, you know, who has the authority, because only the city commission has the ability to authorize something, and then, of course, the city manager has his executive powers.
So it's moot, yeah.
Yeah. So if you could work with staff, and if there is something that needs to occur at a higher level, then I think they could certainly report the action of the Board of Trustees in order to get to the execution, whatever it takes.
Yes.
And again, I'm only concerned about this with respect to if if they do have a CIT and it's significantly less expensive, and we go that way, and then we have to have an executed trust document in place. It's not just buying a mutual fund.
Yeah. That
Okay,
completes
we-
my report.
Okay, thank you, David. Appreciate the report, as always. All right, so we are moving to public input once again. Is there any public input? Please limit your comments to 3 minutes. Any public input? Okay, make a motion to adjourn.
Vote by rising? You can adjourn.
Okay,
You're the boss.
meeting adjourned. Thank you,
See, well before you.
even with the actuary.
Yeah?